Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to episode 86 of Carson's Facts versus Feelings. Ryan and Sonu. Sonu, we have a milestone in the house. We hit 40,000 on the Dow, so we're going to talk a lot about that. This week's podcast is Dow 40,000. Now what? And right before we hit record, you mentioned a headline on Yahoo Finance, and I was actually going to bring this up also. Mike Wilson over at Morgan Stanley. He's obviously been in the bear camp.
Wall Street's biggest bear. That's what Yahoo Finance has it as.
Well,
there are quite a few of them, though.
I love Yahoo. They know how to make the titles great. He upped his 12-month forecast to 5,400 from 4,500. That's a 20% gain. The joke I was going to do was wonder if he just had it wrong the whole time. Maybe he just mixed the two numbers up, the 4 to 5 to 5 to 5. It's close enough. I don't know. Is the end near now that Mike's capitulated? Is that what we're going to say?
If I had to write a headline and connect it to the outlook we put it together at the beginning of the year, I would say Mike Wilson sees eye to eye with the Carson Investment Research team.
There you go.
Eye to eye was our theme for the outlook, by the way, just in case anybody forgot.
Exactly. Yeah. So anyway, we're having some fun there. But seriously, some of these bears are capitulating a little bit. I've said before, you need bulls for a bull market. And honestly, 5,400 is that's, I don't know, what, 2% away where we're at now, Sonu? Very close. It's very, very close. It's not like he's a raging bull.
Yeah. I was going to ask you, does that worry you? Like when Wall Street's biggest bear changes his, I don't know, is it striped spots or, the color of his hide?
Yes. Yeah. Change. I don't know. Yeah. Change something there. I guess it's a little concerning, right? When everyone was bearish a year ago, 15 months ago, and we obviously pushed against that and people didn't like it. It sometimes is almost refreshing the longer you do this to know that you're on a path that not everyone agrees with. And now we're starting to see some people agree, but at the same time, we're going to get into it here. We still see many, many reasons to think that, this is a bull market. We still have likely gains coming and potentially nice gains. But hey, in the near term, that does it does catch my attention. There's some other bears out there. Not going to name them that I'm thinking of too. That if they were to change as well, that'd worry me. But
let's hope
I don't know. Yeah,
they stay where they are. Right.
Oh, there you go. Hey,
Pun intended.
There you go. I know what you did there. All right, so nicely done. So we're gonna again. Welcome to episode 86. By the way, last week 86. Dow 40,000. Now what? If you didn't get a chance to listen to 85, we recorded it the week before live from Partner Summit with all of our Carson advisors all around the United States and different friends and partners were there, and it was a lot of fun. We recorded with Bert White, our new CEO. Bert's been with the company for 2 years now, but recently was promoted to CEO. So if you had a chance to listen to that, it was a great discussion. Talked about the future of our industry, but really also the future of Carson, where we've been, where we are, and where we're going. And with Bert's leadership, we are just so excited for the future of where we're going to go here at Carson Group. But Sonu, let's dive into it. So we're going to talk about Dow 40,000, kind of a stock market, bull market roundup update. Inflation talk. Last week we saw some inflation data. Market rallied, so I guess market liked it. Then maybe a little macro update, macro data. I know industrial production is one thing I wanted to kind of dive into. We'll just see what else we talk about. We'll try to
get there.
We'll try to keep it 40 minutes, and I know with that we can go all day. So let's talk about it. 40,000 on the Dow. What does it mean to you? What you've had the time to reflect on it? What are you thinking about here since we hit 40,000 last week?
2 words: momentum. Well, 3: momentum and breadth.
Yep. That is 3 words, Sonu. So I was going to call you out if
I
not.
was going to say 2. I figured you'd call me out. Momentum and breadth. Why momentum? Well, you need record highs to make new record highs, right? Mm-hmm. Just from that. So, and we've got that. The S&P is at record highs, literally. I believe so, as we speak. Here on Tuesday, May 20th. Oh, Monday, May 20th. Sorry.
Yeah, so it's Monday, but whatever. Close enough.
And then the NASDAQ, it seems strange to say the NASDAQ is at all-time record highs because it's, we've talked about tech tech's in the zeitgeist, right? Everyone's talking about NVIDIA earnings that's going to be out this week sometime. But the sector that's done the best this year is utilities. But then closely, it's not like defensive stocks. Usually when you take defensive stocks, it's staples and then healthcare maybe, or parts of healthcare, not every healthcare overall, but because of biotechs, things like that. But usually the big healthcare firms are, sort of defensive, right? Those aren't outperforming. What is outperforming the S&P 500 at these financials? I mean, you talk about the Dow, the biggest sector in the Dow is financials. If the Dow is going up, making new records, it's not quite like the NASDAQ, right? It's a much more diversified index. I know it's only 30 stocks, but 30 stocks, people say, that's good enough maybe for diversification. Dow going up, that's a good sign for breadth.
They are 30 large companies, last I checked. And you think about it, I mean, 40,000, listen, it's a great milestone. Is there any major difference between 39,999 and 40,000? Well, not really, but I think it's important for investors to remember, stock markets tend to go up. And I know this is easy to say now, but trust me, the last couple of years, we've seen so many people that were bearish, so many people pushing against the idea that over time, investors are rewarded. And the Dow started on May 26th. 1896, so almost birthday for the Dow, and we just hit 40,000. And what I think is really interesting, Sonu, what you just said, look at kind of the makeup of the Dow, right? We know there's a lot of tech in the NASDAQ. Obviously, there's a lot of good amount of tech and communications also in the S&P. Now, there's some in the Dow, but not as much because you've got some healthcare, you've got some industrials, you've got some financials. It's just another sign, I think, that we're broadening out. This isn't all about 7 stocks. We pushed back against that the whole time last year. It was never about 7 stocks. That just got clicks, and that's why they went with it. And yes, those 7 companies are worth a lot, and they accounted for most of the gains. But you look under the surface, there were other stocks going up. It wasn't just about 7. But now here we are, Sonu. I mean, literally, like as we do this, like JP Morgan's at all-time highs. Listen, I don't think that sounds bearish to see, to see something like that happening. Not a recommendation on JP Morgan, just to be aware of. Now, so here's my question to you. And I love the idea of utilities. Maybe let's get back to that. But 7 years ago, we hit 20,000. Okay. It was like January of 7 years ago. 2017. I've got the exact date in front of me here. January 25th. 2017, we closed. Maybe we hit it. I don't know. That's a closing basis. We closed above 20,000. In about 7 years, give or take, we doubled. What are the, I hate to give percentages, but what is the likelihood we double again? We will eventually, I think safe to say, but how soon could it happen? And could we see it, 5, 7, 10 years? Yeah, 8,000. What do you think? When could it happen?
Let's say the S&P is at 3,300 thereabouts. Dow's at 40,000. When do we get to Dow 80,000? When could we see the S&P at? Oh no, the S&P is at 5,300. Now I did the Mike Wilson there.
I'm talking to Mike Wilson. I mean, what in the world? 30? I'm thinking
35.
What's this guy talking about?
5,300. Sorry,
he said it's Tuesday. S&P's down 35%. It's all right. It's all right.
I just turned 46 the other day. Like,
are you sure? Are you sure? I mean, all your numbers are off so far.
I feel like 64, but yeah.
Yes.
So could the S&P hit? Let's say 10,000 and then now 80,000, 5 years, right? So I looked at rolling 5-year returns from 1928 to 2019. Most of the time, 5-year returns are above average. I mean, there's this chart you do that I love, which shows that no year ever has the average return, or it's very rare for every year to have the average return of, say, 9% or whatever it is, right? And same thing with 5-year rolling returns. On an annualized basis, we're greater than about 57% of the time, returns have been much better than average. In fact, returns have been better than 14% annualized, which is what you need for doubling in 5 years, right? Using the rule of 72, right? 14% annualized return or better about 40% of the time. 5-year returns have been negative. This is for the S&P. 5-year returns have been negative 12% of the time, which kind of makes sense. You don't see a recession, and that's usually when profits and sales drop. That's usually when you get a big bear market, think like the early 2000s and then 2008, 2009. Those are times when rolling 5-year returns, if you've timed it really badly, that's when it could be bad, right? But as you go further out, I mean, the odds of doing better than average actually increase.
No, it is amazing. And you think just where we've been the last 7 years when we hit 20,000 and a 100-year pandemic, right? I mean, we've had 2 bear markets, 2020, 2022. Oh, by the way, remember the near bear market in late 2018? I mean, that was
Oh, yeah.
pretty darn scary for a lot of people. Obviously, wars, geopolitical events.
That's true. We've almost had including that, close to like 3 bear
Yeah,
markets.
I mean, believe me, it felt like 3. If you were there late
Yeah.
2018, that felt like a bear market. That was pretty uncomfortable for a lot of us. But again, and then contentious Washington, the elections, geopolitical wars, lots of bad stuff has happened. The other thing that's happened, stocks have doubled. The Dow has doubled. The S&P's doubled in 7 years. So listen, we're not saying ignore the news, because I think it's important to know what's going on out there. But I think it's important. I like to say, separate your political beliefs from your investments. I'm almost going to say separate the news from your investments, almost, because listen, if you would have told someone all those things would happen the last 7 years, I might have said, oh my, I bet the S&P is at 3,300, like Sonu thinks it is, or wherever, but no, that's not the case. A couple other things, Sonu, that I'll bring in. I looked when we hit these major milestones on the Dow. So 10,000 was hit March of 99, 20,000 January 17, and then 30,000 was hit November of 2020. Okay. What happens next? Small sample size, I get it, but still just be aware of these big numbers when they hit. 1 month later, higher every time. 3 months later, higher every time. 6 months later, higher every time. A year later, higher every time. A year
I'm
after
sensing a theme here.
Yeah, a year after the 99 was up 10%. A year after, when we hit 20,000 back at 17, was up 31.5% on the Dow. And
Wow.
a year after we hit 30,000 back in November of 20, up about 19% on average. Small sample size, I get it. But just because we're hitting new highs, don't panic. One more comment, Senator, then I'll bring you in. I found 1,414 all-time highs in the Dow. Now, I started in 1900. The Dow started 1896. I did that simply because it worked better with Excel. Something about Excel. Excel does not like using things in the 1800s. You have to have some macros. I'm not that good at Excel.
Because if you do 99, it probably reads it as 1999.
It reads
right?
it as 9, and there is a way. Hey, maybe there's a listener who can help me with this. But nonetheless, 1900 is a pretty darn long time. 1,414 all-time highs as of last week. Sonu, 1 year later, yes, if you just bought any all-time high, 1 year later, higher about 70% of the time. You're at any time chance of being higher, it's 65% since 1900. Think about that. Up a median 8.2%, average about 7.8%. Both of those also higher than buying any random day. So, of course, there's a period where we're going to buy an all-time high or the market peaks and it rolls over. We don't think we're there yet. I think it's just so important for investors who say, oh, my goodness, I missed this rally. Fortunately, hopefully you listen to this podcast, you didn't miss much of this rally. I'm not saying throw all your money in at all-time highs here, but I am saying don't be scared of all-time highs. Well, what do you think, Sonu?
The momentum, it comes back to that, right? You need momentum, you want momentum, and we like momentum.
There you go. I think I see a hat. I'm going to get you a hat for your birthday. Something like that.
No, momentum works. And that's basically the numbers that you just told us, right? And you always want that. And the other side is, yes, we've reached a record high. And I think it's so important to point out what you just did, that just because we are at record highs, you're more likely to see more record highs than a bear market at this point, right? And that's the point about momentum I'd like to make.
Yeah, let's go back to the utilities leading, because I'll be honest, I grew up, I have a CMT behind my name, right? Chartered Market Technician. I'm a big John Murphy fan. The message of the market. Historically, when you see utility leadership, that catches my attention because that's more defensive. Now, let's remember for a second, the fourth quarter of 2021, the market is making highs. Everything seemed great. What led the fourth quarter? Utilities, staples, and some of those defensive parts of healthcare. Your low volatility names were a lot of leadership back then. And now, listen, the pandemic happened. Maybe if it didn't happen, things would be different. All I know is the market was more defensive in late 2021. I was talking about that at the time with a gentleman named Scott Brown. We used to work with him in a past life. Scott was all over this. And now here we are. And we see utilities leading. But Sonu, should we be worried? Utilities up like ballpark 15% for the year. So the top sector. Let's talk about utilities, but also we're not quite seeing leadership out of the other defensive areas. How worried should we be here?
I mean, just based on, I defer to you obviously with this stuff, but like it goes back to our low volatility stocks. I mean, stocks that don't move too much on a day-to-day, week-to-week basis. They tend to, because if you go down 10%, you need 11% to get back to even. If you go down 20%, you need 25% to get back to even. You go down 33%, you need 50% to get back to even, right? So that's why volatility matters. And stocks that are typically less volatile have done well historically. And that's why when defensive stocks, the other part is if you have a risk off environment, that's when, where is money moving? That's when, like what you just mentioned, staples, utilities, and the defensive parts of healthcare. The good news right now, I think I could label it good news, is that, we are not seeing that drive into staples in healthcare. If we were, I would be a little more, I don't know if concerned is a word for it, but given the macro backdrop, which I think is fairly strong, I mean, we talked about that. But yeah, we're not seeing that. And I think that's positive. I think utilities, there's probably two things going on. One is yields have pulled back, treasury rates, interest rates have pulled back from 3 weeks ago. And part of that is because, markets got really pessimistic about rate cuts this year. Inflation data came out. Powell said what he did after the Fed meeting and again last week. So markets have gotten a tad more optimistic than they were 3 weeks ago. So interest rates fell. The 10-year is, below 450 again, I believe. So somewhere around there. So, and that's good for utilities, right? I think that's what's driving utilities. The other side is all this, we're going to talk about industrial production and the electric grid and all of that. There's a lot happening in the utility infrastructure, if that's the way to think about it in the US. I think there's something going on there. I mean, without getting into individual companies that make up the utility sector.
Well said there. Again, utilities were the worst performing group last year by like a huge margin, by a very wide margin. Now that rubber bands come back on the realization that maybe interest rates are going to come back a little bit. We'll talk about inflation and the Fed next, but just some good context there, because again, it strikes me that utilities are truly leading, but the other defensive areas aren't leading yet. So we're still pretty optimistic we're going to see a summer rally like we've been talking about for the last several weeks on this very podcast. Sonu, one other thing I just took a look at. I know you and I talked about this last October. 1 year off of the October 12th, 2022 lows. The S&P was up 21%. But say only. That was a very weak first year to a bull market, so we were told. You and I pointed out the fact that, listen, the last time we had a first year of a bull market that week was like after the 87 crash, up about 21% that first year, okay? But
which, by the way, is not bad, right? For a year.
Hey, 21% sounds pretty good to me. Now, granted, you probably were down a good deal coming into it.
Sure.
This is when the bear, but you're right. But 2 years off of that low back in 87, the S&P was up 56%. Okay. So here, now fast forward to right now. Right now, off of the October lows, we've had a really good, obviously, just a ripper of a rally since October. We know that. We're up about 49%. Okay. Off of those October 12th lows, but I looked at all the bull markets 2 years off of a bull market or a bear market low. So again, this would be coming up in October, up about 58% on average. So there's still, in my opinion, this isn't even your average bull market when you look at it. It's kind of a little bit weaker, but that doesn't have to be a bad thing. There could be a good deal of potential catch-up. What do you think of that? Because one more thing. Last week, I'm pretty sure I talked about the idea this is a 19-month-old bull market. That's very, very young. Bull markets usually last about 5 years on average. No, they didn't. I loved it. Yeah, a lot of people are angry with the idea that this is a weak-ish bull market. This is a young bull market, but I don't think it's weak for long. I think there's still some more upside coming, but it's young, and that's how we should look at it. What do you think of that, Sonu?
No, there's more room to come. And the good news is a lot of the, let's say, the increase, the rally, if you may, the bull marketness, is that a word? But anyway, I'll use it. Bull marketness has come on the back of earnings growth. Right, go. As opposed to valuations, right? It's not like it's a bad thing if multiples go up, but that's when you hear like, oh, it's all just multiples. That means it's a bubble, because returns can be broken up into earnings growth and multiple growth, right? And then dividends too. Dividends are important. Maybe we can talk a little bit about that. But yeah, no, a lot of this rally we've seen, honestly, even over the last 7 years, you just talked about the Dow doubling in 7 years. Earnings expectations for the Dow going back to what was the date you mentioned? January 25th, 2017. Since then, through last Friday, forward earnings expectations for the Dow. I use forward earnings expectations because the market's looking forward as opposed to backward. That's up about over 80% over the same 7-year period, which means most of that doubling, the 100% return you got in the Dow from 20,000 to 40,000 has come on the back of earnings growth.
Nice.
As opposed to multiple growth, right? And then there's dividends too. So the Dow doubled 20,000 to 40,000. That excludes dividends. If you look at total return for the Dow Jones using an ETF we follow, it's actually up about 130%. So dividends are important. Over 7 years, you got 30% additional in top of the 2x just from dividends, and most of the rest was earnings growth.
Yeah, I know we share a lot on social media, X specifically, and a lot of times people say, the bears will say, well, but inflation adjusted, we're not up that much. And I'm always like, that's true, but now add dividends, right? I mean, dividends and inflation kind of just almost offset each other to a degree,
right,
and then
exactly.
price is what's left. I mean, it's not that precise, but pretty darn close.
One other thing, close. That's a very important thing. Dividends have historically grown at the pace of inflation.
And so it's a nice way to look at that. One other thing, we mentioned the rule of 72, and I just want to point this out because I wanted to bring this up. So hit rewind here in the podcast for a minute. Rule of 72 is a very easy way to find what the percent gain you need to double. So let's say you want to double in 7 years. You take 72 divided by 7. That answer is 10.2, right? It comes out, so right about 10% is what you need to double. If you have 5, so 72 divided by 5, that answer is just over 14%. That shows you what type of return you need to double. So if you 36% 2 years in a row, you would have just doubled, right? 72 divided by 2. So the rule of 72 is a really cool thing. I mean, you're a lot smarter at numbers than I am, Sonu. Who came up with that? I mean, I don't know. It's so cool. I don't know. Somebody smart came up with it, right? Probably like or Leonardo or somebody like that,
or somebody lazy. I'd like to think of, like, I don't want to punch this into whatever machine or calculator you had to say. Like, let's just use this rule of 72. I feel like every finance person probably has to go through a test that asks you that question.
Yeah.
So,
well,
I know a lot of people listen to this who are not in finance too.
Hey, lazy people created the wheel. Lazy people created, I think lazy people created like Uber Eats and DoorDash. I mean, there's some positives to being lazy out there. Anyway, all right. So Sonu, I don't know. I think we covered about everything. Anything else on equities, stocks at all-time highs before we talk a little about inflation you wanted to touch on there? I think that's what I wanted to talk about.
No, I think how much? Yeah, I'll add this. We were talking about valuations of earnings, right? We were talking about the Dow, but the S&P is also at new highs. And so it hit its record. It passed the record that it hit on March 28th. Yep. So on March 28th, year to date, right, 3 months over the first quarter, the S&P is up 10%. Like I said, you can break that down into how much came from earnings growth, how much came from multiple growth. 3 percentage points came from earnings growth. 7 percentage points came from multiple growth. So you can argue, it's multiples, it's valuations, it's sentiment, positive sentiment, exuberance driving the S&P to record highs by the end of the first quarter. 3 + 7, 10%. But now on May 15th, the S&P passed that March 28th high, new record. So year to date through May 15th, 4.5 months, the S&P was up 11%. But this time it was earnings that drove that, right? Earnings growth accounted for 5 percentage points of that, multiple growth 6 percentage points. So we've sort of equalized. The good news is most of that earnings growth. So earnings growth you can separate into sales growth and margin expansion. Most of that growth in earnings came from margin expansion. That means companies are expanding margins even as sales are growing. But that's what you see in a strong economy, period.
No. Well, nicely said there. I mean, again, we've talked a lot about earnings and earnings coming in strong, right? Earnings season's almost over. Now, listen, NVIDIA is still, they're still out there. They can swing things a little bit, but listen, they've we'll see what happens. But so far, earnings coming really strong. I mean, like forward 12-month estimates just since the end of March are up over 2%, looking about $255 expected on the S&P 500. Now, I get it. Those are expectations 12 months out. It can change. Most people, when they hear that, they assume it has to come in low. Hey, listen, in a world of higher productivity like we're seeing, when are some of the best years of economic growth and earnings beats? Mid to late 90s. When you have higher productivity. We have higher productivity now. We've talked a ton about that. Not going to say too much more, but just because we assume the worst, maybe we can also assume there could be some positive things there. So Sonu, next week is episode 87. We're joined by Jeremy Schwartz. Again, we pre-recorded this a couple weeks ago at Partners Summit in Omaha. Jeremy Schwartz, I'm not sure of his exact title, but Jeremy's over
a global CIO, Global Chief Investment Officer at Wisdom
over at Wisdom Tree. And it was a great discussion. Without giving it all away, what should listeners look forward to next week?
He's got great perspective literally about what we are talking about. Earnings, inflation, how that increases over time. And making the case for stocks, because right now bonds have, if you can get 5%, 5 to 5.5% on a CD. Yes. So there's always a question, why should I bother with something like that's zero volatility? You know you're going to get that, right? Why should I bother investing in stocks? Well, stay tuned for that episode.
Yes, that's one. Oh, there you go. Good way. And then, of course, we were joined by Jeremy Siegel, also, thanks to our friends at Wisdom Tree. That'll come out in a couple weeks. Also, that was a great conversation. But we've hit the halfway point or so. So let's talk about inflation. We talked about the market at all-time highs. We've been bullish. We've been overweight. That's good. But one of the drivers for why last year we think stocks did well is because inflation came back. Now, Sonu, inflation has been stubborn this year, but we saw PPI and CPI. PPI came in a little bit hotter than expected. CPI, honestly, I don't know. I guess just didn't upset the apple cart, but the reaction to the market, 2-year yields dropped significantly. 10-year yield dropped significantly after the CPI. Let's talk about inflation. What did you see last week?
I'm wondering when we can stop talking about inflation. You're not, what, this is episode 86, right? I feel like we've been because we started the episode like September of 2022, which is around peak inflation.
Yeah.
Like, what are we going to talk about if you don't have inflation anymore to talk about?
No.
You'll find something. I'm sure
we'll find something to talk about. But that's true. We do spend a lot of time on inflation, but I guess it's also been for a reason, because we thought inflation was going to improve and it's going to help the market. So take it away.
Look, this is the relief report. We got 3 reports in like Jan, Feb, and March. They were harder than expected, and then everyone is like, by April, when we got the March report, everyone was like, oh, is it stagflation? Because remember, we got a GDP report that was less than expected as well. So suddenly we were like, wait, low growth, high inflation, is it stagflation? No. This is not stagflation. Let's be clear, right? So headline inflation, CPI, Consumer Price Index. And goodness, Ryan did not ask me to explain CPI, PPI, and PC again.
Yeah.
No, we've done that. No, CPI is the one everyone follows, and let's talk about
the
that.
Consumer.
The Consumer Price Index. That was up 3.4% over the last 12 months, right? Now, we've spent a lot of time talking about this. Shelter, housing inflation, which makes up about a third of CPI, is what's keeping things elevated. And speaking of inflation's already a backward-looking measure, right? So it's nothing that tells you about what's going to happen. It tells you what's happened. Shelter is even more lagging than that because of several methodological issues, right? It tells you, if at all, you can look at the trend and see the good news is the trend is coming down. The trend shows a downshift, especially rents of primary residences. Owner's equivalent rent, which is what you and I are presumed to pay ourselves as homeowners, that's on its way down. It's still elevated, but the good news is it's not going up. It's come in much cooler in March than it did in the first 3 months of the year. Here's some perspective. I'll wrap this up kind of this way. We can spend as much time as you want, Ryan. As you know, talking about inflation. Core inflation was up 3.6% over the last year. 85% of that 3.6%, so about 3.1 percentage points, came from 2 categories: housing and auto insurance. Auto insurance, by the way, makes up just over 3% of that core inflation basket. Housing makes up 43% of the core inflation basket, makes up about a third of the overall basket, but about 43% of the core inflation basket. These 2 categories contributed 3.1 percentage points out of the 3.6%. Again, this is all backward-looking stuff, right? As Powell mentioned last week, a lot of that heat, the inflation heat in the first quarter, was due to post-pandemic catch-up effects, right? Like auto insurance, because car prices went up. Repairs are more expensive. We're catching up to all that, but we should see that subside as we move forward, because car prices are not rising anymore. In fact, it's going down. So there's no, as Powell said, there's no renewed inflationary pressures from an overheating economy. When you think about, okay, how can I tell what may happen to inflation as we look forward? 3 pieces. What's happening in demand? Well, wages are easing. Wage growth is around 3% annualized. That's, what we saw before the pandemic. Quits are lower as well, so there's not a lot of turnover, which means the labor market is strong, but it's not red hot. So there shouldn't be any demand side pressures on inflation. Supply side, we're not seeing supply chain issues. We're seeing auto assemblies run at the pre-pandemic pace. Commodity prices, I know copper is at a record, gold is at a record, but oil's in a pretty tight range. Right? Yeah. If oil is at $100 a barrel, I would get worried, but it's not. It's closer to $80 a barrel. Then you think about the third leg of that stool, when you look forward and think about, okay, what's inflation? What could it be doing, say, 2 months, 3 months, 6 months down the road? Look at expectations. Consumer expectations, yes, they're up short term. because of gas prices. That always happens. But if you look at 3-year expectations from the consumer, it's only slightly above pre-pandemic levels. Business expectations for inflation, that's around 2.3%. That's in line with what we saw before the pandemic. Then finally, market expectations. If you look at what we call break-even yields, it's nominal interest rates minus real interest rates. That gives you market expectations of future inflation. That's consistent with the Fed's target of 2% core PCE inflation. I will keep my mouth shut now.
No, that's very, very good stuff. I mean, just a few comments from me. You mentioned used cars and automobile prices and used cars and trucks. I think I mentioned it last week, mentioned again, but the Manheim used car index has dropped significantly the last 6-7 months over the last year. Finally, and that's finally working its way to the. By the way, Manheim is apparently a city in Pennsylvania. I didn't know.
Oh, I didn't know that.
I didn't either. I heard that once. I hope I'm right on that. But yeah, it's apparently where they do a bunch of auctions.
Is it near Springfield? No, I don't
know.
No, I was joking because I feel like there's a Springfield in every state of the country.
Hey, I grew up in Springfield, Ohio. So
I
you don't
know.
Tell me. Yeah, exactly. They're everywhere, man. They are everywhere. But anyway, down 1.4% according to the government's data on used cars and trucks. That was after being down 1.1% the month before. So if you think about it, we had higher auto insurance, drastically higher auto insurance, like you just talked about, because automobiles cost more and it's more expensive to fix these cars because of supply chain issues. Those things are really starting to improve. So that's probably not going to be the issue. We've talked a ton about shelter and rent. So you mentioned before, shelter makes up about 17% of PCE. That's the one that probably we should focus more on because that's one the Fed says they focus on.
Yep.
But shelter makes up 43% of core CPI, with 33% of that being OER, owner's equivalent rents, and only 10% being rents, primary rents. Well, that part has really started to crack. That 10% part has really started to crack, come down. If OER follows, which, listen, I know you're just listening to us talk here, but historically it follows. If OER follows the way rents are starting to go, we could see a big time improvement overall in the two big issues with inflation that we've had, the last year or so, again, being auto insurance, recently, autos and shelters, auto insurance and shelters. So who knows? Maybe other parts of inflation come back. We'll see. We follow the data every month, but that's really important. Final thing, Sonu, is what the Walmart CEO said. I don't have his quote in front of me. Going to paraphrase it. We did a Spaces last week with Lindsay Bell. That was awesome. Thanks, Lindsay, for joining us. And then I know Neil Dutto over at RenMax pointed this out also on LinkedIn, but I'm going to paraphrase it. But just the prices that they're seeing on a lot of the things that they buy and they use at Walmart and sell are coming back. He actually used the word deflation. He used the word deflation in some of the pricing that they're seeing at Walmart. So again, that is the largest retailer in the United States, last I checked. He said the consumer is still strong, and he used the word deflation as they saw that. So again, those are some real-world examples of why we think, inflation's coming back. And then the Fed, let's talk about the Fed, I guess. Anything you want to add on Walmart or inflation? Maybe let's wrap it up with what the Fed does now.
The deflation piece that Walmart CEOs mentioned, the fact that he mentioned that was interesting. Yes, we are seeing prices come down. Actually, this gets to a question, Ryan, we got this morning, right, when we did a call for our partners. They're like, oh, will prices come down? Prices are still high. And I want to differentiate between price level. Like, if you were paying, I don't know, $3 for eggs, for a carton of eggs 4 years ago before the pandemic. Is it 4 years? Yeah, thereabouts. A little over 4 years ago. Maybe now you're paying $4.50 or something like that. They think, okay, prices have gone up 50%. Will it go back to $3? And Ryan, do we want it to go back to $3?
No, I don't think so. Because if that, kind of, that'd be bad.
Yeah, I mean, yes, from a personal perspective, but no, we don't, because you go ahead.
Yeah, I mean, I think bad things are happening. Keep it simple. I mean, like I've used the example before, like say you buy some toilet paper, it used to be $15, now it's $22. I mean, yeah, that's more, but if it goes back to 15, that probably means some bad things are happening. And we've talked a lot about, incomes and wages are still growing faster than inflation. Real incomes are still strong. Real consumption is still strong. So, be careful what you wish for, I guess what I'm going to say, because if that happened, well, we're not going to be getting 5% on money markets anymore. You might not be having stock market all-time highs. Maybe housing, who knows? If rates go lower, maybe housing goes up. So there's a yin and a yang to everything. But the bottom line to me is those prices you were paying 4 and 5 years ago probably aren't coming back. And that's just how things work over time. What the market cares about is year over year change, not the absolute value. And that's not right. It's not wrong. It's just the facts. Yeah. This is facts versus feelings, right? We're giving the facts right now. So to us, I don't think we want to see deflation, because deflation is a bad thing, and that could be a problem.
Yeah, you get prices down if you have a deflationary recession. I mean, not guaranteed, but I think it's safe to say.
And
Well, the good news is food inflation is continuing to ease, right? Food at home, grocery
right.
prices was actually down 0.2% month over month last
Yeah.
month. And it's up, I say just quote unquote, right? I'm using air quotes. It was up 1.1% year over year. Food away from home, so stuff you buy at restaurants, bars, things like that, fast food restaurants, that was up 4%, just over 4% year over year. That's
Hmm.
kind of in line. It's slightly elevated relative to the average before the pandemic, but we've
Mhm.
seen numbers like that even before the pandemic. Sometimes you get a spike, sometimes it goes
Sure.
down. But you've seen that. The good news is if you look at full dining restaurant meal inflation, that's running at 3.4%. The peak a year and a half ago, 2 years ago, was 9%.
Hmm.
3.4% right now is pretty much where we were before the pandemic. Again, like I said, this is a good bellwether for core inflation because it tells you,
Mhm.
what goes into the number for restaurant meals, worker wages, commodity prices, food prices, energy prices for
Well, but
transport,
time out.
all of
I can tell you where the meal goes. It goes in my belly. I know where the meal
the meal
goes. I don't know
goes
what
there.
goes into it. Yeah,
Yes,
exactly. That's where the
yes.
meal goes. Yeah.
And then rents of restaurant premises. So you have so many things that are reflective of what's happening in the economy that
Mhm.
drives restaurant meal prices, right? And right now, inflation there tells me that inflation's not a big problem anymore. To be honest,
And that
prices are
right.
high. I'm not saying prices are not high. Yes, prices are high, but inflation is not a problem anymore.
Yeah, and that obviously, when people hear that, it kind of brings certain emotions, maybe upsets people. But again, we're just our jobs as stewards of assets is to give our opinion on how we see things. And again, we see some improving trends on inflation. Believe me, everybody wishes it would be a little bit better, but we think the second half of this year, again, maybe there can be some reasons it can be better. So, Sonu, I'm going to ask everyone to help us out by telling us how we're doing. Leave a review, give us a like, and subscribe if you want to hear the latest of Facts versus Feelings. I wanted to mention that. Anything else I wanted to mention, Sonu? Because I know we want to talk about industrial production. I guess that's it. I have to go after we do this. I have to go clean my car out because I'm picking up this really big time important.
Yes,
My wife's like, you better.
celebrity.
Yeah, celebrity. My wife's like, you better clean your. It's not that dirty. I said he doesn't care. But anyway,
Hey,
no,
I have
Sonu.
kids
Yeah,
too, so
yeah, yeah. Anyway, Sonu's flying to Cincinnati. We're doing something tomorrow together, so we're going
that'll
to
be
pick
fun.
him up at the airport. And I was just thinking restaurant. I've spent more time the last 2 days where I want to take you to dinner. The problem is all the places that I like. Here's like real world problems. Like they're all closed on Monday. Literally, all these
Oh
restaurants I
no.
like in Cincinnati because they're like smaller mom and pop, like
Sure.
specific to Cincinnati. They're all closed on Monday. I was like, man, you got to
Wow.
come back on a different day. Well, it's all right. It's all right. We're
I
gonna
will
figure
come
it out.
back.
We're gonna figure it out. We're gonna figure
Yes.
it out. But the final thing, Sonu, we've got about 5 minutes or so. I want to try to keep it close to 40 minutes if we can. Macro backdrop: industrial production. Right, industrial production came in a little bit weaker than expected.
Mm-hmm.
That data came out last week. I think the month before, maybe a little weaker also. And what we hear is manufacturing is really starting to slow down, I guess is a better way to put it.
Mm-hmm.
Industrial production showing some problems, but you looked and you found some potential positives. Believe me, there might be some negatives too here. But what do you see when you look at industrial production?
So manufacturing by itself is not a big piece of the economy. So I don't want to say it's not important. I do think it's important and critical because we saw what happened in the pandemic when
Mm-hmm.
we were outsourcing everything, right? So I think there is stuff coming back there's reshoring and nearshoring. There's a lot of stuff happening in Mexico and Canada too, as
Yep.
part of that cycle of bringing things back from Asia into, like, let's say North America. But a lot of things happening in the country, in the US as well. So manufacturing, yes, it eased. I mean, see, this is where this is an area of the market, I think, or the economy that's really been impacted by higher rates. Because we talk about, the consumer's not really being impacted because most households, a majority of households are paying less than 4% interest rates, right? So the Fed raising rates hasn't impacted them. But what it has impacted, yes, obviously new housing purchases because mortgage rates are high, but
Mm-hmm.
also production, the supply side in terms of industry and the industrial economy. I'll put it this way: if interest rates ease, if the Fed cuts, I think we could see a big boost to manufacturing activity. But
Yeah.
let's talk about where we are right now. Right. The good part is there are certain critical pockets I look at within the industrial economy that's doing pretty well. Autos obviously is a big thing within the industrial economy. The good news is auto assemblies, vehicle assemblies, it's running at the pre-pandemic pace. That's good from an inflation perspective too, because it means more cars are coming up into dealer lots, things like that. So we should
Mm-hmm.
see downward pressure on car inflation, maybe not
Right.
prices, right? But I think used car prices are also coming down for that matter. So there we are seeing some deflation there. And last month, new vehicle prices also went down. So maybe their prices will go down. But then
Yeah.
another big important piece is high-tech equipment production. We talk about AI and semiconductor chip manufacturing, all of that. High-tech equipment production, that rose another 1% in April. It's up 26% from December 2019 levels. By the way, this is inflation adjusted because we're measuring volumes. So, and we can see if you look at a chart of this, and I'm sure we can put it online, you see a clear upswing in 2023. That was the CHIPS Act, the IRA.
Yep.
By the way, all that to say there's more to come here. Then we are talking about utilities, Ryan, electrical equipment production. This has to do with the grid and transmission lines, things like that. That's up about 17% from where we were before the pandemic. Again, this is inflation adjusted. We've broken out of a decade-long stagnation. If you look at a chart, 2010 to 2019, it was more or less flat. It went up, it went down, it went up, went down, right? Now we've sort of broken out of that. So there are big things happening under the hood of the economy, on the industrial side of the economy. And finally, one last thing, defense production. You talk about the election. Yes, it matters, but it matters less for markets, as Ryan's pointed out several times in the past, and he'll continue pointing out over the next several months, I'm sure. But defense production is something I think we'll see even, after the election, irrespective of who's president. Defense production is up 12% year over year. Again, that's inflation adjusted, right? And like I said, I think this continues, and that's going to be a boost for the economy.
Well said there. We've talked a lot before about some of the surveys, the soft sentiment surveys. The 300 purchasing managers have felt one way about manufacturing, but then you look at the hard data, the industrial production in general, and some of the manufacturing outputs and things like that. There have been some positives out there. And again, manufacturing makes up, what is it, 12, 13% of the economy, Sonu? Something like that. Yeah. So we're not ignoring it. Maybe it's a canary in the coal mine, maybe. But again, if we see some rate cuts, you'd have to think that's going to help housing significantly, maybe manufacturing as well. How much does housing make up? Like 20%? What is housing?
Housing is interesting,
volatile, right?
Yeah, housing, resident. So it's within GDP. You have consumption, which is 70%, government, which is about 17% or so.
Okay.
Net exports is usually a drag because you have a trade deficit.
Yeah.
And then you have investment. Investment is business spending. So investment is two pieces: non-residential investment, that's where all the manufacturing stuff is, and then you have residential investment, that's housing. Residential investment is actually just 4 to 5% of GDP.
Okay.
But it's volatile. So it can suddenly, it can drag a lot from GDP, or it can add a lot. Last quarter, it added about 50 basis points, 0.5 percentage points to overall GDP growth, right? So I think, before that, I think, up until last year, there were 9 straight quarters where it was a drag.
That's what I was asking. So it was 9 straight. It was a drag, I believe, 3 in a row now, actually, an addition.
3 in a
just
row,
imagine if we saw some rate cuts, how much of addition that could be.
Somebody goodness, I'm blanking on his name. Econ Strat is the ticker handle, I believe. He said, if we get rate cuts, I mean, the housing, that's like meth for the housing market.
No, it is. Yeah, that is a very good point. So, all right, we've kind of gone probably about as long as we want to go with episode 86 of Carson's Facts versus Feelings, Dow 40,000. Now what? It is Memorial Day coming up, so we want to send a thank you to everyone out there who's kept us safe throughout history, currently keeping us safe, and obviously giving the ultimate sacrifice to keep our country safe. Do you guys do any traditions? Absolutely. Do you guys? Thank you to everyone, for sure. Do you guys do anything special in Chicago over Memorial Day? Anything happen with the family? Or
usually it's a time to catch up. I mean, we're getting all our spring stuff. Spring is sort of over, and we're like, oh, it's summer now. So then,
it's hot. This week's like record highs. By the time people listen to this, it's like record highs all over the East Coast. I know that.
I should pack light then for Cincinnati, but
it's gonna be hot here too. 80s. It's 80s.
It's always like maybe 5 degrees cooler up here in Chicago than it is down in Ohio, where your neck of the woods. I mean, I travel to Columbus often enough too because my wife's family's there. But we're here. It's just getting ready for summer. We did some shopping. My daughter's like, oh, I need new clothes for the summer. She's just 7. And I'm like, what do you need new clothes for the summer?
Yeah, it doesn't stop the 16-year-old, I'll tell you that. Yeah.
But no, plans and, all of that. And we catch up with some family in town as well. What about you?
Yeah, my wife has a wedding on Monday. I'm not going to go. It's like a family thing, so I'm going to stay and watch kids, I guess is what I'm going to do on
Quote
that's
unquote,
on
watch
Saturday.
kids.
Yeah, that's on Saturday. But then there's something called Taste of Cincinnati, which like you would think is like 100,000 people come
Oh, wow.
downtown and they have all of the restaurants. It's outside, right? So like food trucks and booths and things and a couple hundred different restaurants. So I always enjoy going down there, walking around,
Oh,
getting some
nice.
food, just kind of enjoying. So I got to figure out a time to do that, maybe
Speaking
Saturday
of,
afternoon. Yeah.
there's a Wing Fest at Wrigley Field on Saturday of Memorial Day. So maybe I'll hop down
Oh,
there. Yes.
I mean, you're really
I just
close to
remember.
Wrigley, right? I mean,
Yeah,
you're like walkable,
walkable. Yeah,
or yeah.
literally half a mile up the road.
That is walkable.
If
So
anyone listening on the podcast is at Rib Fest, not Wing Fest, there is a Rib Fest as well later in the summer, I think, in Chicago, not far from where I am. But if you're in Wrigley or something, come and say hello. You may see me there.
yeah, and I think it's time to eat, Sonu. I'm getting hungry. People can tell it's about lunchtime for us the way we're talking here all of a sudden. But everybody, this was again episode 86 of Facts versus Feelings. Thank you for listening. Thanks for Chelsea, our producer, as always, and be on the lookout for last week's with Bert White, and then next week's also with Jeremy Schwartz over at Wisdom Tree. But hopefully you enjoyed this one. Have a great 3-day weekend, everybody. Markets making highs. Economy looks pretty good. Fed's potentially going to be a little more dovish. All in all, things look pretty good. So let's enjoy it. Enjoy a 3-day weekend. We'll see everybody next week. Take care. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.